Hi, everyone. We're going to get the session started for today. My name is Ruby Eisenbud. I'm an MBA student here at MIT Sloan, and I'm here to introduce the session. Before we begin, I just want to remind you all to please submit your questions using the Whova app. You can do that by clicking on this session, and then there's an option to submit Q&A. You can also upvote the questions, and we're going to be monitoring the questions as the panel goes so that those upvoted questions are asked at the end of the session. We appreciate your participation there. I think it's going to be a great discussion. Today's topic is the future of food. The global food system is a major contributor to climate change, but it remains under-discussed and under-financed. Today's panel will explore how different forms of capital, from venture to corporate, can help drive a more resilient, low-emissions food system, and how leaders navigate the tension between short-term market pressures and long-term sustainability. Moderating this session is Ali Awad, Assistant Professor of Operations Management at MIT Sloan. His research sits at the intersection of operations, economics, and technology, with a focus on market design, supply chains, and decision-making systems. And I just have to add in here, I'm actually one of Ali's students, and I have the privilege of sitting in his class twice a week, so I'm really looking forward to today's discussion. And with that, please join me in welcoming Ali and our panel. Thank you.
Hello, everyone. So to give maybe just a brief intro to the discussion that we look forward to have here with our panelists, I think as we were preparing this panel, we kind of realized that the food system sits at an interesting and a bit strange intersection where, on the one hand, it is maybe one of the biggest contributors to climate change, but it is also one of the most exposed to environmental risk and climate risk. And still, it is perhaps one of the sectors that is the most underfunded to undertake this transition. Now, what you'll hear from our panelists is that financing this transition is hard, but it's not intractable. And one of the kind of touchstones to the discussion is like the issue of permanence. So in order to enable transition, we need to have more permanence to enable kind of, for example, soil health improvements and all the adoption of sustainable practices, and also the shift of supply chains takes time, and yet patient capital is precisely the fundamental issue that our panelists have been thinking about and working on in the past decade. So today we're very fortunate to have a panel that combines expertise and viewpoints from three different seats in the capital stack. So Matthew Tretto is the Chief Investment Officer at Fractal Agriculture, and he'll tell us about equity, an interesting and innovative model of equity investing in farms. And our second speaker, Amr Addas, is a Senior Director at Farm Credit Canada, which is a crown corporation organization with a mandate to support long-term viability, including in agri-food and farming. And last but not least, Vincent Gauthier is a senior manager at the Environment Defense Fund and has long experience in understanding and modeling farm-level economics and financial risk when it comes to the adoption of climate-smart agriculture. And so as you can see, we'll have perspectives that cover different sectors, the nonprofit, the private capital, as well as governmental capital. And to kick off the discussion, I'd like to just ask you to tell us a little bit what drew you to the sector, and quite frankly, what does your day-to-day look like? So if you could tell us a little bit, each of you. Yes, maybe you can start, Matt.
Sure. So thanks for having me. What brought me to agriculture? I think agriculture is a very interesting kind of intersection between a lot of different problems that are in the world and a lot of different potential solutions that are out there. So it keeps me kind of on my toes on a day-to-day basis. It sits at the intersection of the food system, i.e. we touch the food system as humans and consumers multiple times a day. It has impacts on climate change, environmental biodiversity, conservation, community health, et cetera. I also come from a bit of a farming background, actually here on the North Shore of Massachusetts, so kind of keeps me entertained there as well. My day-to-day, so I sit as the investments lead at Fractal Agriculture. We are a fund management or a fund manager who works with investors and with farmers to provide them with equity capital in the form of financing for their farmland, essentially. So we work with farmers who want to leverage their existing farmland and or buy new farmland. So we will come in as an equity partner with them. So I spend my days looking at deals, looking at different markets across mostly the US Midwest. I should specify we focus mostly on the US Midwest and row crops here in the United States. So think corn, soybeans, wheat for the most part. It's the predominant kind of crop rotation and crop mix here in the United States. So
Thanks for sharing. Yeah.
Sure.
Anna, please.
Yeah, thanks, Ali. Well, great to be here. Thanks for having me. What drew me to agriculture? Well, I'm a recovering academic, so I spent about 15 years as a finance professor at a business school. So this feels like partially triggering, but also kind of like home territory in some ways. And I studied business at University of Michigan as well back in the day. But what drew me to agriculture was, well, first of all, I was kind of looking for a new challenge, and the timing was great because this opportunity came up at FCC. And Farm Credit Canada, or FCC, is a crown corporation, which means it's owned by the federal government of Canada, but it's independently run with an independent board and CEO. And we have a mandate. So this was an organization established in 1959 with seed capital from the federal government. And since then, it's been operating independently and profitably as a financial crown, which means we are essentially a bank, a lending institution that has one shareholder. So we pay a dividend to the government. And in 2023, a new CEO came in. She had been the Chief Sustainability Officer of EDC, or Export Development Canada, another crown, financial crown. And she came in and basically recognized exactly what Ali and Matt were talking about, which is agriculture is at the center of climate change, both from a risk perspective and opportunity perspective. And it makes it such a unique sector in that sense. And FCC is also a unique institution in being a financial institution dedicated to a single sector. If you think of all other sectors in the economy, you do not get a bank or a financial institution dedicated to supporting and providing capital to a single sector. So she came in, submitted a new corporate strategy, which was adopted by the board and executive committee. And that corporate strategy embeds sustainability at the core of what FCC does. So FCC is about $65 billion in assets, most of them in lending, senior loans, but also a growing component in venture capital, so direct equity investments and investments in funds. And the new corporate strategy has sort of the mission is to be bold in making Canada a global leader in food security and sustainable food production. So that's really, when you look at a country like the Netherlands with 5 million people, tiny territory, Netherlands means lower territories, right? So it's barely the ground is below the ocean. And they're the second biggest exporter of food in the world, right? Canada is in the top 10, but huge land, right? And agriculture is massive in the prairies, which are between Alberta, Saskatchewan, Manitoba, which is north of North Dakota and Montana and these areas. The joke is if your dog runs away, you can still see him running the next day because it's so flat. Right? It's all prairies, all row crops basically. So Justine submitted this. Our CEO submitted the strategy. It was accepted, and there was no sustainability capability at FCC at all. There was no sustainability team. There were like 5 people doing community investment and all the kind of nice to have stuff, but no corporate sustainability capacity. So it was a blank slate, a great opportunity to build a team. And so that's kind of a bit of a long story on how I got there. My day-to-day, my team basically does the due diligence on transactions that FCC labels as sustainable financing. Right? So we have a sustainable finance framework, and my team does the assessment on any transaction that we consider to be potentially sustainable. We conduct a full due diligence, assess, we map it to our framework. We go through the process of ensuring there's no significant harm to other activities. And we also look at the environmental and social risks of any traditional investment, even non-sustainable, whether there's any material or significant risk that might impact the business from sustainability perspective. So that's at a high level. And then what we also do is we create content and thought leadership and insights that make the business case for sustainable investing. The saying goes, you can't go green if you're in the red. So no producer, no business is going to make an investment that makes no financial sense. So my team creates the content and the business cases and the ROI and sort of the overall analysis of every component of our sustainable finance framework, how we make the business case for it. Because if we don't, nobody's going to invest in it, even if we give them any incentives.
Thanks. And Vincent, can you share a little bit this
Yeah.
way? And,
I think you're
in all fairness, you know each other. I
Yeah.
understand also that this group has also met before.
I know,
as
it's
well,
going to be fun.
Yeah.
Well, Ali, you're like one of the first to introduce me with my French name. It's refreshing. It gets butchered a lot on panels, so thank you. I came to agriculture because I grew up in a household where I had parents that were environmental advocates, and they cared a lot about food, they cared a lot about the environment, and I'd hear comments growing up to the effect of, why are farmers doing what they're doing? Why are they spraying all this pesticide, herbicide, fertilizer? It's all ending up in our water, that kind of comment. And I was lucky in that childhood to then go work on farms, work on dairy farms in eastern Pennsylvania, work on dairy operations and horticulture operations in Vermont. And it's when I stepped onto those farms and worked with producers that I was like, because it's not that simple. And producers don't really have and operate in a system where they can make choices to be better stewards of the land and the environment as they would hope they could be. And so that's what brought me to better understanding both the environmental impact of agriculture, but also the economics and the system that puts producers in situations where they have to decide, am I going to make money this year, or am I going to do something that better improves the land and the water that my communities rely on? So that's why I came to this work, and I'm very fortunate to, on a day-to-day, tackle that issue. And I get to tackle it in the most fun way, which is to engage with producers to understand from the ground up, what are their constraints? What do they wish they could do and why? And then work with their closest financial partners, agricultural lending institutions, crop insurance companies, food and agribusiness companies, to try and figure out how we can make the system work in a way where producers can invest in improvements in soil and water while improving their profitability and their livelihoods.
Thank you, three, for highlighting different pathways can lead to food systems and to agriculture, and that's maybe something noteworthy to everyone in the room. And all of you kind of can hear that this sort of tension or trade-off here between where we want to head and what's actually feasible, and the incentive, the concrete economic incentives. So maybe just to let the room appreciate what are the current struggles, challenges that are happening for agriculture in America and North America. Can you touch on some of the things, let's say in the past year, 2 years, that could help us understand the current situation a little bit? Maybe Matt, I go back to you.
Sure. Well, to start, row crop agriculture in the U.S. has been kind of a tried and true industry for a long time now. So the United States government and farmers are incentivized to maximize their production. We were talking about this a little bit before, right? And it's a complicated system, one that has differing incentives. There's crop insurance that dominates a lot of the risk mitigation for farmers. And that crop insurance system ultimately incentivizes them to maximize their output every single year when it comes to yield. So this structure has historically made it difficult until I'd say maybe the last 5 years or so. And I think Vincent could talk better to the smart agriculture programs that are becoming a little bit more common, I think, across the Midwest to incentivize better soil health practices and potentially, moving away from that growth at all costs, right? Because that growth at all costs includes, at least historically, maximizing fertilizer, chemical, and everything else that's done at kind of the industrial scale to maximize that production output from that farm. So the current system today, I think that's, farmers will react to their risk environment that they operate in, and they, Vincent said, there's limited options for them. They grow a commodity crop. Some farmers have gotten into specialty crops that do allow a little bit more flexibility, whether there's an organic premium, et cetera. Those sorts of programs have started to come up. But in general, farmers, I mean, the margins on a US farm on average through a cycle are, what, 2%, 2 to 5% at best. And there's cycles, right? I mean, we can all look at the price of a corn chart, or corn prices on a chart. It's massive volatility. These are weather markets that drive, huge amounts of risk every year for a farmer. They don't know if they're going to have, the best crop that they've ever had, or have, 2012 situation where crop yields were 30% below the year before, and that creates crises. So the crop insurance system is there. Farmers use it as they should, but the constraints of kind of that crop insurance system do handicap them a bit.
And so is this something that's structurally also the same in Canada, that the crop insurance system is currently like setting some perverse incentives, or at least gridlocking kind of farmers into thinking about yield and productivity before kind of being able to engage with these?
Yeah, it's the classic short-term versus long-term, right? So they are incentivized to act in the short-term interest, and disincentivized of investing in long-term resilience, which really is illogical, but that is the system that we operate in, and we can get technical. Probably Vincent is the best to get technical about that stuff because he knows it really well. But it's really, your insurance coverage is based on your average production over the last few years, and adopting more sustainable or regenerative agricultural practices is not a straight line of improvement. It's a J curve or a hockey stick, right? So initially, you're going to make an investment that will disrupt your whole operation. You're taking a risk by doing something that's very different. And farming is very personal, right? I mean, most people have been in farming because there's a family history, right? And the parents and the grandparents and so on. And there's one thing that I learned when I first joined FCC is that for a farmer, or producer is the term mostly used in Canada, they get 40 chances in life to get it right? And that's 40 seasons on average. If you lose one, that's 2.5% of your revenue, your productivity, throughout your career. So they're not incentivized to take that risk. And the risk is if you adopt different practices, if you reduce the use of fertilizer and pesticides and so on, in order to build up more soil organic matter in your soil, and improve the soil health and so on, that's going to take 2 to 5 years, right? And during that period, your production is going to be, your yield is going to go down, your insurance is going to be affected accordingly, and so the incentive is simply not there. And so there are innovative products that are being developed. We at FCC, and I know we'll talk a bit about this later, we're in a unique position to be able to offer some patient capital and to support farmers as they potentially undergo that transition. But it's ultimately a mispricing of risk. It's a market failure, right?
Market failure. And maybe since you've prompted us on this, can you go on the technicality? Maybe can you give us an example, a concrete example of like a practice? What does it entail in terms of like, what is the impact on yields and the short run, long run? How should we think about the timeline? Can you go into some more specifics, just as one example that would be illuminating to the audience?
Yeah, sure. Okay. You mean like specifically of a climate smart practice, or
of a climate smart? What is the staple climate smart practice that trying to?
Yeah. Well, one thing I'll start with is, North American agriculture is quite diverse and quite expansive. North America is a pretty large continent, and we produce a lot of agricultural goods. And so I think we sometimes make the mistake when we think about climate smart agricultural practices, or conservation practices, if you might want to call them, is that we talked about them as like one set of things, when in reality, when you think about production of almonds in California as compared to growing corn and soybeans in Iowa, the sustainability and the natural resource management is very different under those circumstances. In the upper Midwest, or in the Corn Belt, as you may have heard the region called, most of the rotation is corn, soybeans, and sometimes wheat, sometimes sorghum. In those operations, the major issues that producers are trying to manage is the health of their soil and water. And so in mostly rain-fed agriculture of the northern parts of that Corn Belt, if we're thinking Iowa, Illinois, Indiana, a major impact that those operations have and have to manage is both their soil and their impact on local water quality. And so a set of practices that we typically think of as the next set of improvements that these operations can make is including keeping a continuous cover. So think of a large agricultural field. It's brown, right? In the winter most of the time. Well, it doesn't have to be brown. It could be kind of green if we were planting cover crops or some type of winter crop that can help maintain the structure of the soil, that can help move water more effectively and in some cases store water more effectively in that soil. Then there's tillage practices. We can reduce the amount of times that we disturb that soil. We break up the nice aggregates that create air, which is really critical for growing crops. So reduced tillage is the second practice. And then nutrient management. So of course, to grow nice, tall, and bushy corn crops, you have to put fertilizer in the ground, nitrogen fertilizer, but if you over-apply it, it all ends up in our drinking water. And I don't know how many of you have read about the cancer rates in Iowa. It's not pretty, and a lot of that is because of the nitrates in their water. So if we can reduce some of that by applying nitrogen at the right time, the right rate, the right type of fertilizer, we can reduce some of that impact on local water quality. So those are the types of practices in this example of the upper Midwest Corn Belt that are really important. The challenge is that these practices in many cases have impacts on short-term risks as compared to long-term investments. So not all of agricultural land that producers work on in the US is owned by those farmers themselves. Most of the time, or I don't know, what is it, 60?
45%?
Yeah, is owned by the farmers themselves. In many cases, they're renting that land. And so they're making an investment in someone else's asset, someone else's natural resource if they're going to add extra cost by planting a cover crop. And so there's short-term risks of trying something new. You all know when you try something new, if you try ice skating and you've never skated before, you're probably going to fall on your face. A lot of risk there. But the investment in the long term of reducing your tillage, planting cover crops, makes that soil healthier. There's a lot more biological activity, a lot more carbon in that soil that the crops can use to both manage the ups and downs of good and bad weather and also grow, in some cases, a better crop into the future. So producers on a short-term basis, they have to pay their rent, like many of us do. So you have to make a good crop to be able to pay your rent. And so you might not add that extra cost, take on that extra risk of doing these practices that improve the underlying asset if it's not your asset and you need to pay rent. And so for producers, it's not really set up in a way for them to both balance short-term risks and actually gain the value of what they're investing in on the ground with these practices.
Yeah. Interesting. And for some people, ice skating never improves. But
Yeah.
So this actually touches to, it seems like this market failure, like a big driver of this market failure is a fundamental mismatch of timelines in terms of like what the capital is willing to fund and the kind of the durability, the permanence that's required to kind of see the benefits and see through these changes. So I'd like to turn back to Matt and ask you about how the innovative model by Fractal Agriculture is trying to resolve this problem through this 10-year equity model. So can you tell us how it works and what does it enable a farmer to do that they would not be able to do with a conventional form of capital?
Sure. So at Fractal, we take the position as a fund manager alongside our investors that investing in the soil will be an investment in the farm for the long term, right? So a lot of the things that Vincent just mentioned, and soil organic matter buildup, carbon sequestration, all of these things that become the result and the output of all of these or some of these regenerative practices over time, help with various things on the farm down the line, right? So there's water, water retention on a field with soil with higher organic matter, soil organic matter, it's going to be much higher. That is going to result in better production during years where you have drought, for instance, right? And we've seen that show up in some of the data. So We also believe that, over
So
time,
retention of water,
retention,
humidity
yes.
in the soils.
in the soils, yes, over time.
Can you explain on carbon sequestration, what that concretely means for the...
Yeah. I want to get into too much of the
detail.
carbon side here. That's a whole different panel, I think, and we can definitely get into it. But over time, the amount of carbon that is stored in the soil from implementing practices like no-till or reducing tillage and cover crops, it builds up, right? And carbon is a part of that. It's not the whole part of it. But in general, like I was saying, like water retention will be much higher in fields that have these practices than those that do not, right? And farm in a more kind of traditional sense. So that's one side on the kind of the top line, right? So we expect better production in terms of like lower volatility on yields going forward, especially in an era where we believe that climate change is going to impact farming as a profession in many of these regions that we're talking about in the Midwest. And the second is on just lower dependencies on inputs, right? So if you have higher soil organic matter, generally, you might not need to apply nitrogen as heavily as you have in the past, or other NPK inputs that you depend on. We've all seen what geopolitical volatility has done to fertilizer prices over the last 2 months. Those sorts of things can make or break a farm on any given year. So at Fractal, we take the position that this is investing in the soil is investing in the farm and the viability of the farm in the long term. So what Fractal does is we take a 10-year contract, an investment with the farmer, and that 10-year contract allows adequate time for either a farmer who wants to transition to some of these practices or a farmer who's already been implementing these practices. And what we do is we give them discounts essentially on the rate that they pay. So our model has, we deploy capital and deploy equity, similar to like a sale leaseback structure, similar. We take a minority position, so we own up to 45% of any given field, and the farmer will pay us a rent-like equivalent, an income payment on that 45% share of the field. We benchmark that to kind of local rental rates and whatnot, and then we will give discounts to that rate based on how many practices they're implementing. And so with more practices, we believe that the value of the land, because of the lower input costs over time and just the lower volatility on the yields, will result in just a better value for the land in the future, and hopefully that farmer continues to farm that. But in the case that they don't, the farmer can buy us out of that position at any point in time during that 10-year contract. And when the 10-year contract is up, we can either re-up that position or they can go their separate ways.
And so what is the farmer's kind of perception or typical kind of understanding? What is it that draws them to this financing scheme? Is it the upside of like getting these discounts or rebates as a function of like adoption, or is it kind of the access to capital? So can you tell us a little bit what is the value proposition from their perspective as well?
Sure, it's a little bit of both, and you will have some farmers. We have some farmers that we partner with that are, I would say, on the lower side of adoption, right? So say 2 practices or 1 practice, right? We have some farmers who have 6, 7 practices, and we have our own definition of practices. A lot of them are overlapping with ClimateSmart and other programs that are out there, carbon programs, essentially, that are science-backed and have research that prove, soil organic matter will be built up. The second that we haven't actually touched on is the farmer's ability to secure financing and capital, at least in the United States. There's really 2 paths, and they're both debt if they want to maintain control of the field. You have local community banks who lend to farmers, and you have the farm credit system and the various implementers across different regions in the United States. A lot of times, I would say, greater than 70% of the times, these institutions will have caps to the amount that they lend against land. So call that cap a 60% loan to value on average, right? And that's on a low volatility asset that has great investment properties to it. We can go down that path if you'd like, but high correlation with inflation and just structural soundness of the asset in terms of return profile, better risk return than the S&P 500.
So you're talking about the land itself? Or
The farmland itself.
Farmland itself.
Correct, yes. And so banks take a fairly low LTV. If you think about if you go buy a house, you can put 20% down and the bank will lend you 80%. A farmer, more times than not, will need to put 40% down. And so Fractal, the other the other kind of pillar that we have is we will actually go up to an 80% LTV for that farm. So we can be used as a supplementary financing tool for a farmer who wants to go buy another field. Or they can use us up to 45% and then finance the rest in debt.
Can you touch on some kind of success stories, like from farmers' perspective? Can you give us a glimpse into what it looks like in terms of change and adoption?
Sure. So I think there's a couple different paths. The first, there's a lot of farmers will come to us, right? Because for a farmer, having proximity of their operated land to their home base is very important. And oftentimes they'll have landlords that they've farmed for decades, right? This land is almost, it's almost like non-negotiable for them if it comes up for sale. They have to have that land for their operation because, number one, in the US, you have to grow continuously in terms of your acreage in order to survive long-term because those margins are so small. And, second, farming that land or not farming that land and losing that land would be devastating for their operation and because it brings it back the other way. So we've had a lot of farmers come to us and look at, buying out their landlords and trying to make that work. But if you're in a downturn, an economic downturn like the farm economy generally is now, having the equity and having the free cash to put down for a down payment for that becomes difficult. And so we've had, regenerative aligned farmers that will come to us and they look at our premium rates and income rates that we have, and we're much lower than debt. We price off of what's a cap rate structure essentially in agriculture and farmland. So think of it as kind of a rental rate divided by the value of the land. And they look at that income rate, it's generally lower. It's actually much lower right now than debt rates. Debt rates are fairly high right now. So they will look at our structure and they'll say, this just makes financial sense. And we're able to help them secure pieces of land that are vital for them to have over the long term, while we're incentivizing regenerative practices for them to continue that on this new piece of land that they've been operating.
So there's both a social component and a kind of environmental, sustainable practice, like I mentioned.
Yeah.
And so moving to Ahmed, can you tell us a little bit as well, in its own way, how FCC's current corporation mandate gives it kind of a different horizon than the commercial banks? And so what kind of concrete maybe projects or examples of initiatives that came out of this funding model in Canada or in North America?
Yeah. So yeah, we are in a unique position because we receive a mandate from the government to support the sector, right? So quote unquote, support the sector means really, again, back to what I said earlier, that we're unique in being a financial institution dedicated to a single sector. We can't walk away, right? So we're tied at the hip with the sector. If there's a component of the sector that's not viable from a sustainability or environmental perspective, we can't divest. We really are a universal owner in the agriculture sector. And so that gives us flexibility, and we have the mandate also gives us flexibility to apply more patient capital, for example. And this year, our fiscal year started April 1st, we have an explicit dollar target of taking net new higher risk. And that applies across the board in many ways. It means lending to, as an example, greenhouses that have been struggling recently with higher input costs, right? So greenhouse business is quite popular in Canada and has been growing, but their input costs have been rising, following pandemic, and equipment costs have gone up and so on. So we're taking more risk by lending, accepting lower collateral, for example, not requiring the same level of loan to value and all that. So that's one example. Patient capital means also we get to work on a project like the one we're working on with EDF, whereby Vincent and I were in Ottawa just this past week, launching his new project, which I'm sure he'll be, it's a plug there for you guys, but it's a great project, the Great Lakes Protection Fund, and it's both in the US and Canada. And the project is basically to attract producers that are willing to adopt these more riskier sustainable agricultural practices. Riskier meaning taking that short-term risk in order to have healthier soils in the long term. And it's funny, it's like when you look at human history, we've discovered farming, and in the long term, that more older way of farming is actually a lot more sustainable for the long term and keeps the soil healthier. Like not tilling the land, for example, right? We only started tilling the land when we had the tractors and equipment that would till it, right? Now in Canada,
Ignorance is bliss.
yeah. And in Canada, you have I'm sure in the States as well, you have a large amount of land that is not tilled anymore because you have these advanced technologies, the seeders that can plant the seed 6 inches below the soil, and you don't need to cover it anymore because it's already untilled, and that allows it to retain more organic matter, right? So, and that kind of takes me to agriculture being a really surprisingly industrial and technologically advanced sector. I think more than most people realize how technologically advanced agriculture is. So going back to the project, so the idea is to get a number of farmers, producers that would adopt these more sustainable practices, take the risk over the short term. We'll give them patient capital. We'll give them things like interest-only loans, so they don't have to. So cash flow management, the saying is, farmers are asset rich, but cash poor, is very true. And so cash flow management is extremely important for them. So if we don't ask them to pay back a loan for up to 5 years, they just pay the interest. That helps with their cash flow in the short term. And the hypothesis that we're testing here and hoping to find evidence to support is that adoption of these sustainable practices leads to more resilient operational resilience and financial resilience. And if we can demonstrate that, then we can go to our risk teams and our finance teams and price it accordingly, right? So the traditional banking model is every dollar you lend, you have to put aside X amount of pennies that you hold as equity so that you protect yourself, right? If we can make the case to our business teams that we actually don't need to hold so much equity aside, we can lend more if we lend to more sustainable farmers, and therefore we make more money in the end. So we're experimenting with different ways to demonstrate that.
So if I want to kind of go down that path that you just laid out, and so it seems we want to deploy this patient capital and maybe take more risk or different forms of risk, but as operations professor, I guess like the other side of the equation is having data to support this and to measure what is the impact and also understand kind of the risk and the exposure.
Yeah.
And so I want to kind of go to Vincent and ask what kind of evidence, data, measurement is currently available to both kind of inform this transition and accompany this transition?
Yeah, I like to think of it in 2 categories. So the challenge when we think of properly financing the transition to climate smart agriculture, there's one, understanding what the financial risks and costs of the transition looks like, and that requires data from farms that have implemented those practices. So unfortunately, like 5 or so years ago, most of the data that we had on that was from case studies of very conservation-minded champion producers. And so all the data was like, oh my God, it's amazing. Like, man, we should all be, why isn't everybody doing this? But it was like, the champions. And so, because in reality, we were hearing from other producers of like, oh yeah, that guy did it that well, but like the rest of us actually had a pretty hard time. It didn't go so well. And so what we've been investing in over the last couple of years is building out data sets that producers trust, because that's really important, that are continuously gathered, and that are at a scale that gives us some power to have a sense of the range of financial costs that transition looks like. So one example of that is we're working with the University of Minnesota. They have a program across the state of Minnesota and surrounding states where they provide farmers direct financial and record-keeping education. So they go to the farm, they go to the kitchen table and work on the producer's accounting and financials. They do benchmarking analysis, they do tax preparation, all that stuff. In exchange, they get really good real financial data from real farms that they anonymize and aggregate up to get a really good data set of farm financial performance, balance sheets, et cetera. We have integrated conservation or soil health practices within the way that they gather that data so that we can parse out what does it look like for the producers that are using, as Matt described, those practices that are improving the soil health versus those that are using conventional practices. So that data is really important so that we understand what does the cost and risk look like of the transition. Then what Amer is talking about is from a financial institution perspective, really need to understand, is there a difference in the risk profile of the producers that are implementing those practices and those that aren't? In the metrics that a financial institution and its regulators actually utilize to set their pricing and the regulatory oversight of those financial institutions. So that's like a different set of research. And that requires like academic rigor level of certainty for a regulator to say, okay, that should be priced, that risk should be priced differently than your conventional operator. What some preliminary data has shown is that, for example, in Illinois, the University of Illinois had access to data from the federal crop insurance program during 2019, where there was significant flooding in the upper Midwest that caused a lot of corn and soybean acres to go unplanted. And so they filed for what we call prevent plant insurance claims. They had access to enough data across the United States Department of Agriculture to be able to conduct research on, is there any difference between the fields that were using practices that maintain the soil cover during the winter, that reduce the amount of tillage of that soil? And they found that there was a 24% reduction in the likelihood of prevent plant claims during that year for the fields that were using those practices. And that's across thousands and thousands of fields across the upper Midwest. That is the type of data that we need for the Farm Credit Administration, for financial regulators of commercial banks to start saying, okay, this is a different class of risk with this pool of producers as compared to your conventional producers. So in our perspective, we're really working on both of those types of data. One is really working with academic institutions, pairing them up with financial institutions so that they're doing the research that financial institutions actually need, which sometimes researchers and the private sector don't have the same sense of exactly what is needed from a research perspective. So we held an event earlier this year in DC and brought together those folks to really understand, like, what are the research questions that would price that risk effectively? And then, as I said, that transition financial data that we can understand better, so we can do the transition financing, as you said, Amber, 0% or financing or interest-only periods to match the transition period and risks that producers face.
I can relate on kind of the interface of academia and kind of real-world problems. You know, something we can work on that together. That's another panel.
Yeah, good partnerships, you know.
But I'm curious on, is this also an area where technology and innovation, thinking about like, you know, future business leaders or like people want to create startups, want to innovate, are there like ways to generate data that you think would be worthwhile to kind of resolve this sort of information gap? Is this something that...
Well, I'd say remote sensing is providing a really a strong new ability to understand where practices are happening when on a continuous basis. So we can overlap those with financial data more easily so that the power of that type of research that I talked about can be had more rapidly. So we have better detection systems now using satellites to be able to say, okay, there was, you know, that field right there did have a cover crop over the last 3 years, that one didn't, allowing us to be able to then match that up. The challenge sometimes is that the way that we consider like a unit in agriculture, the field boundary, like a lending institution doesn't always have that. And so sometimes you can have great satellite data that is useless because you can't actually match it up with any of the financial data. So some financial institutions are starting to be able to better map out essentially their risk exposure, like where's the actual field that I have that mortgage loan on, like can I actually draw the line around it so that I can compare it with the financial data that I have about that operation. So that's one capability that I think is really, has improved that we can really leverage.
And it can be developed further.
I'd love to add on that, because definitely remote sensing is doing some crazy things of like identifying chemical composition of the soil from a satellite at depth. So it's crazy. But what's really interesting to see as well is the role of AI that, not surprisingly, AI is starting to play. So we have, for example, at FCC, our tech team developed something called Root AI, which is an AI agent that helps producers answer questions related to agricultural management. But they're also developing a digital twin that will allow a producer using a software called Ag Expert to conduct scenario analysis, essentially, right? If I'm getting X percent or so many milliliters of rain in 2028 growing season, given my inputs, given my costs, what would be my net profit in the end, right? So this kind of visualization and scenario analysis is extremely useful and a way that technology is contributing to helping farm management.
Yeah, it's been for many years a lab instrument. Now you can bring it directly to the farmers, maybe thanks to AI and digital systems. And actually, this is something we're doing research on here at MIT, understanding the impact on farmers in interacting with these types of systems.
Yeah.
So let's say that the numbers kind of work on paper and that we can make the financial case in some sense, and we have the data for that. But we still need to convince the farmer in a sense. And I think that the farmers also respond to data, and their data is also very oftentimes experimental, like trying out things on plots and see how whether that works or not. So I'm curious if there are other kind of if we broaden the discussion beyond kind of capital for a second and things, what are the kind of the barriers and other frictions that what makes one farmer kind of shift from one side to the other? So going back to you, kind of Matt, I wonder if you can touch a little bit on what are kind of these frictions and how can you kind of convince farmers or somehow diffuse these practices among the farmers? What are the levers at hand?
Sure. Yeah, kind of like we discussed before, farmers can be very entrenched in kind of the way that they've always done things. You hear that a lot, or at least I hear that a lot, right? It's not the way we've done things. It's not the way my father did things or his father did things. So it becomes a little bit of an entrenched mindset to start, right? I think you're starting to see some farmers be a little bit more open because maybe their neighbor joined a carbon program, or maybe their neighbor played around with no-till for a season, or put a cover crop in the ground and had various results. We had a farmer, we were in central Iowa, so north central Iowa, and this is very common with just the hog intensity that's out in Iowa. They'll apply manure, right? They'll do offtake from manure and put it on their fields to replace some of the N that they normally put on their fields. This one farmer in particular, he had realized, he had talked to his agronomist, and he had realized that he was potentially over applying, right? And he gets it for free generally, or at a very low cost, right? To facilitate the offtake. And he had started to kind of get his head going around, okay, well, maybe this isn't maximizing my output. Maybe this is something that I need to figure out and maybe need to change a little bit. And so when we talk about some farmers will apply nitrogen in the fall, which ends up being,
evaporating.
Much different, or leaching or whatnot, depending on the weather in that season. But generally speaking, these are the things that start, and it usually starts by having adverse impacts to output over time. Mm-hmm. So when they see that their yields may be, not accelerating as much as their neighbor or their county, they might start to think about things a little bit different. So, changing a farmer's mind without evidence, like Vincent was saying, like statistics, and a lot of these farmers lean on their agronomists, right? So it becomes kind of a trust thing, and their agronomists have to, be very much in the loop on what's happening on their specific fields. Obviously, the soil makeups of every field is very different for each farmer in general, even within a 20-mile radius. So each thing is very hyper-local as well, and knowing what they have to do. So
I'd love to comment on this because it's like I have some stats here, so I might as well use them.
Yes.
Put some context here. So if you go to a farmer in Alberta, which is kind of, we call it the Texas of Canada because it's very, there's a lot of oil and gas, a lot of cowboys, and the moment you utter the word climate change, you're going to be asking for trouble. If you have the same conversation in Quebec, it's very different. Quebec is very European, right? And it's so when we talk to a farmer in Alberta, we're not going to talk about climate change, but we're going to talk about the fact that they've been experiencing drought for the last 10 years. Who cares what caused it? It's happening. There's no prospect for it going away. right? And here are the stats. 53% of Canadian farmland faced drought in the 2025 seeding season, which is exactly a year ago. Over half of farmers faced drought in Canada. 51% of producers experienced drought and 26% flooding over the prior 3 years. Losses impact, or weather-related losses impact 88% of grain farmers, 76% of dairy farmers, 71% of fruit and vegetable farms. So staggering data. So that's one reason that farmers will respond to these types of scientifically proven solutions that will impact or make them more resilient. Another super important reason is the demand from the value chain, right? You have McCain, biggest producer of French fries and potatoes in the world, that's committed to 100% of their suppliers, potato growers, have to qualify as, they have a tiered system of scoring farmers on regenerative agriculture. All their producers have to qualify by 2030. PepsiCo just doubled their target for supply of regenerative agriculture in the last few months. McDonald's has similar commitments, right? So the key here is that you get the value chain in, the grocery stores that are making these net zero commitments. We could open the carbon sequestration and carbon credit conversation. That's probably going down a rabbit hole. But like there's an in-setting, right? So if they want to reduce their emissions, if they reduce the emissions in the value chain, that helps them get to their own decarbonization targets. So the key here really in this conversation is to understand the dynamic and the social reality that producers don't want to and cannot take on the whole risk themselves. There has to be skin in the game from the whole value chain.
Yeah, so I'm hearing here that the question of who bears the risk in this transition is essential, and maybe we should diffuse kind of the question from the farmer to being completely farmer-centric and thinking more broadly about the entire value chain. And so I know when we were discussing this aspect of like corporate commitments and supply chains, that Vincent had also some kind of points on maybe the challenges that might arise from these types of commitments. I wonder if you wanted to kind of share a little bit about.
Sure. So mostly the way that food companies have, and even like honestly in the U.S. federal government, like the way that we've gone about de-risking investments on the farm for conservation or climate-smart agriculture has been, hey, we'll just pay for part of it, go test it out for a couple of years. And that's nice, but like what if the risk or the barrier to trying it out isn't the cost of that year trying that practice out? And so we've kind of used like a pretty blunt instrument to try and manage risk and other financial barriers. And I think there's a lot of opportunity, and there's a lot of organizations, I mean, like Fractal is testing some of these things out in understanding what is the actual financial barrier that the producer is implementing, or a social barrier, which is as important, and then like fixing the tool to that problem. So for example, we've had, and sometimes it's also between the financial institutions or the outside stakeholders that aren't on the farm that don't understand one another's role and how they could be supporting each other's role to help the farmer in making their investments. One good example recently that we found out is, so we've been working with the Innovation Center for U.S. Dairy, which is funded by dairy farmers across the United States, to develop a dairy impact fund that would help improve the financing options that commercial banks and the farm credit system provide to farmers for investing in technologies that reduce the greenhouse gas impact of dairy operations. And we found in the development of that fund, we've done a lot of stakeholder engagement, right? We've shown up to dairy events, we've talked to dairy producers, to farmer cooperatives, to financial institutions. And one of the things that we found out is the financial institutions right now, they look at any type of payment from a carbon offset program, or what we call insets, basically companies within the food value chain paying for claims of environmental reductions in their own value chain. And the financial institutions look at that type of revenue, because it's revenue to the farm, and they, in most cases, entirely discount it. So they're underwriting the loan for the project, and they're saying, that revenue, we don't really believe that it's going to come through. The companies have no clue. They had no clue at the time that their commitments in not engaging with the financial institutions were being entirely discounted. And so they were frustrated that their investments weren't turning into projects on the ground that were delivering those greenhouse gas reductions that they could claim in their 2030, 2050 goals. By bringing those stakeholders together and saying, hey, if you showed the contract, the consistent contract that you're providing to producers to say, we will pay you X amount per ton of greenhouse gas reduced to the financial institution, they'll actually be able to underwrite it. If you extend the term of that contract to better match the financing term of that piece of equipment that's going on the farm, that'll have a significant influence on whether that farmer can finance that project. And so we too often are only thinking about, well, yeah, we're fixing the problem. We're putting dollars on the farm. That should fix it, right? That should de-risk it. And we're not thinking about the ways in which the stakeholders that want that outcome to happen on the farm, how they're actually affecting one another's ability to provide that transition financing, that transition de-risking to practices or projects that are environmentally beneficial.
It's interesting. So it's a supply chain coordination aspect.
Exactly.
Here that
Yeah.
almost like better understanding can lead to unlocking, these value streams.
Yeah.
And so moving a little bit upstream to the kind of the one of the kind of central points that we started with the discussion about insurances. So if you were like, what is the pathway to kind of think about redesign or innovation in the insurance space that would enable kind of moving away from this kind of productivity intensive model and kind of enabling the transition? I wonder, Matt, if you have kind of thoughts or suggestions for us.
Yeah, that's a loaded one. There's a lot there. I mean, in general, the crop insurance system has provided farmers with a safety net that they would not be able to have survived without. That is just a fact. And the federal government, at least in the United States, has taken on that risk. The recent legislation that went through actually increased the amount of dollars that they get to increase the revenue levels of insurance. So there's a lot of incentives going into the Farm Belt right now for various reasons. So I think over time, with climate smart ag programs, chipping away at these and finding these holes, right, and working in tandem with off-takers, and those points are super valid that Vincent just went through, with large CPG companies putting their money where their mouths are, right, and ensuring that those payments are actually going towards creating the change and catalyzing the change that they want in their products. Now, I'd say it all comes back to the consumer and all of us in this room, right? I think in my experience, when you talk to a farmer, they'll tell you that they will farm any way that we want them to farm, essentially, as long as the incentives are there and as long as these structures are there for them to survive year after year through climate change, through all of these risks that they deal with every year, just to keep the lights on. So I think that the private and public sectors kind of working in tandem here are probably the longer term solution, and with the ability for other private capital allocators to be involved and incentivize things the way that a specific investor or a fund mandate might look for, I think are probably the more structural paths to move forward here and find the right risk.
So it's not a
balance.
different type of insurance, if I hear correctly, but maybe a complementarity of different forms of capital and insurances and risk kind of instruments that you think would kind of bypass
it. It could be a different type of insurance, and there's actually, I've talked to a few of the larger insurance companies out there, some of European insurance companies, trying to structure a product around, regenerative transitions, whether it's no crop or no-till and cover crop.
Yeah.
Because you do get that dip in the beginning, much like an organic transition, right? You get that yield volatility in the short term. It's an S-curve, essentially, right? Mm-hmm. And so having that type of security through that transition, while not having adverse impacts to the more structural crop insurance that they have from a federal level, is really the key to unlocking at scale. at least for the risk profile that these farmers take on. Yeah.
It's something we haven't talked maybe too much about is like how these sort of incentives set by the kind of insurances and just in general kind of the agricultural model have also consequences in other countries, like in the global south, for example. And I recall like when my first job actually many years ago was in trying to understand the impact of these incentives on productivity of farmers in countries, emerging, like middle-income countries like Morocco. And in many cases, what came out of it is that these incentives were decentivizing smallholder farmers and farmers in these countries to upscale and grow their production because they were not competitive, given kind of the kind of highly integrated incentives that existed in countries like the U.S. and in Europe. And so when you mentioned this, I thought, interestingly, that 20 years later, this is still happening, and in some sense, quite an important structural aspect of global food security that we should also have in mind in these discussions. And so moving to in terms of thinking about capital risk complementarities, and particularly in your role at FCC, can you touch a little bit on how you think and how you view kind of these different stacks of capital kind of working together in a way that can be kind of productive and synergistic to facilitate the transition? So
yeah. So we're really experimenting with different approaches. So one of the things that we're doing is in the early stage, we're standing up, and we've been supporting a network of smart farms or innovation farms around Canada, and there's a similar system here in the United States. And Vincent and I visited one in Ottawa on Tuesday. And on those smart farms, what they do is they experiment with different technologies, right, to see what works, what might be from a scientific and technical perspective an effective solution, be it drones or precision ag, or we saw a really cool drone on Tuesday that was like flying. But what they've done is typically stopped at that, right? So trying different technologies and demonstrating, and then it becomes a bit more of an academic exercise. So what we've done is we've come in and we're now deliberately connecting those networks, those farms together, and creating a kind of incubator where we're going to be looking at applying our venture capital funding capability and the value creation aspect of it, because we're so central within agriculture in Canada. We can connect the company. If we identify that, okay, this technology works, we're going to connect you to potential buyers, to potential, the value chain that can help you stand your business up. Plus, we're going to provide you with seed capital. We're going to give you the financing we need. We'll potentially lend you money as well. So that's one way we're deploying our capital. And I'll just give an example of because probably it's a bit abstract, but some really super cool technologies that we've funded. There's a company that does enhanced rock weathering. And this is like for engineers, it'll be interesting to understand. So the natural process of the absorption of water in rocks, certain types of rocks more than others, is that they absorb carbon in the process, right? So what this company does, it's a mining company essentially that mines wollastonite and crushes it, and therefore exponentially expanding the surface area of the wollastonite, and therefore by putting that crushed wollastonite in the soil, it absorbs a lot more water, and it also happens to improve yield. So it acts as an impetus to reduce fertilizer input. So you're reducing costs for the producer, you're improving the yield, and you're sequestering carbon at the same time. So that's a technology that we funded. We've invested in equity in the company, and we've also connected it with potential buyers. Another one, and I have to mention this just because it's crazy, it's a company that collects up to 250 tons of food waste per day and feeds them to 8 billion flies, black soldier flies, that are then harvested as chicken feed. And apparently for the chicken, this is like catnip. You shake the bag and the chicken go crazy because you're harvesting the larvae, and it contains like some chemical compositions that are very attractive for the chicken. And then guess what? The 8 billion flies, their waste is used as fertilizer. So all of these things allow us to deploy our capital in a way that's innovative. But then to your initial question of blended finance. Blended finance is kind of a tough nut to crack because you need government money. You can think of it as 3 stacks: government money or first loss capital, or be it through grants or tax breaks or outright dedicated capital. Then we can come in and take on more risk and still at commercial level, but maybe we would be the next level, the next layer that could potentially absorb risk. And then you can bring in the commercial level terms, private investors, and so on. So that's something we haven't quite arrived there yet. It's conversations we're having. The government of Canada last week announced this force of nature policy to explicitly incentivize the 30 by 30 targets of preserving 30% of biodiversity by 2030. And so agriculture plays a role in that. So there are ongoing conversations with government. We're not quite there yet, but we're working towards it.
Okay, well, thanks a lot. And as we'll be kind of opening up to the audience, maybe I want to ask you one last question to the three of you. And you've already touched on this during the discussion, but what do you see are the biggest opportunities for future business leaders to play a role and make a difference in the food system? And if you were to give a piece of advice to a Sloaney or to a kind of an MBA student about what to do like in the next 12 months if they want to be part of this sector, part of this effort, what would be your advice? So I'll start with you, Matt. And
Sure. I'd say to approach agriculture a little bit differently than you approach other industries. It's very fragmented, it's very nuanced, and it's a sector that is notorious for destroying other models like that work from other sectors, right? And that's just what it's been. It's very fragmented. I would say to focus on the risks aspects, find the common pain points between the farmers or the CPGs or the other market players that you're looking to work with and build a business around. Oftentimes, those commonalities kind of meld into who holds the risk at the end of the day from a financial. I'm speaking more so from a financial lens. So yeah, I think I'd say focus on the risks and where the risks are held.
thanks.
For me, I'd say that there's, at least in Canada, there's an upcoming massive asset transfer in farming from older farmers that are about to retire in the next 5 to 10 years to younger generation. And farming is changing dramatically as a result because there are lots of innovation, technology, and opportunities for growing beyond just the traditional farming business that is making the agriculture sector really on the cusp of a generational opportunity of transition. And of course, given all the technology being developed, it's one of the areas where there's a lot of innovation, a lot of investment in technology. Plus, as an asset class, it's also a great diversifier, and Matt had alluded to that earlier. So I think there's a lot of exciting stuff happening in agriculture. So I would say look at how high-tech it is, look at how industrial it is, and look at the business opportunity there in getting into a sector that's at the forefront of climate change and climate innovation.
Thank you.
I'll say if you want to work on an agriculture solution, go talk to farmers. So often in my own organization and organizations I work with, we end up making some pretty stupid mistakes because we assume what producers want, need, do. We don't live where they live. We don't deal with what they deal with. Go talk to them. They're always so happy to talk about what they do. Yes. My brother-in-law operates a dairy operation in eastern Pennsylvania, and man, you can sit there and talk about his farming operation like for the whole day. So don't be afraid to talk to farmers, and definitely do it because that's where you'll find the most impactful solutions, is if you base it off of their day-to-day and their needs.
Thanks for that word. Yep, and I think we can open up to the audience for questions.
Amazing. Thank you all so much. This has been really exciting discussion, very rich. We have about 7 minutes left on the panel, so I will ambitiously try to get to 2 questions. So out of the top voted questions, I'll take one in the same vein about careers while we're on this topic, and then one about the space in general. So about the space in general, this is in a slightly less optimistic vein, but can you give an example of something that hasn't worked and a really important learning from it that has been helpful? A product, an incentive structure, or an approach, anything that hasn't worked and led to a surprising learning.
I think to my last point about like talking to producers, there is a product that was developed in the federal crop insurance system here in the US a few years ago. So one practice that is good for nutrient management and not having a bunch of your nitrogen end up in your drinking water is to apply that nitrogen in 2 small bits at different times of year where the plant is more likely to uptake that nitrogen. But there's risk associated with that because you could have really bad weather right around when you have to do that second application, and then you're nitrogen deficient, and so your crops don't grow as much. And so producers face that risk, and honestly, mostly academics went about saying, okay, well, we can create an insurance product for that problem. And producers weren't really asked about, what was the risk that was preventing them from doing it. And a lot of it was more operational than actual financial risk. They were willing to take that risk, and they had more flexibility around when they apply that second set of nitrogen. And so we created a product, not we, but like collectively created a product, 5 years worth of development. It was approved by the Federal Crop Insurance Program, and almost no one bought it. Just because there was a lack of engagement from the beginning. There weren't these roundtables surrounded by producers talking to the academics saying, well, our real problem is this. And so I think to my last point of advice is this failure that occurred because we didn't talk to producers.
That's really interesting. And then going back to the career question, what roles in this space are actually hard to fill right now, and how can these grads acquire those skills to step up?
That's a good. I could take that at least from an FCC perspective. So getting actual what we call RMs, relationship managers, that are actually on the ground and closing the deal. That's a tough job because by definition, any sales job is difficult. So this is where we're not struggling to recruit, but we're struggling to retain talent. So that's definitely one area. And then on the data science, this is where again with like technology and AI and so on, our business is increasingly being matured in terms of technology and becoming more sophisticated. So it's hard to keep up with how fast AI is developing. I think it probably applies to every sector, but we're really bracing to raise our technological capabilities and embed AI within our business. So that's one area that we're seeing a lot of growth in as well. And I'm always hiring on my team. So if anybody wants to apply to work in sustainable finance at FCC, you'll find me on LinkedIn.
Amazing. Thank you for ending on this very optimistic note. Yeah, and also focused on innovation, very much in theme for MIT. My name is Raisa Rani. I am a second-year MBA at Sloan, and on behalf of the organizing team of ClimateCAP, I would like to thank our panelists so much for their time today, and to Professor Ali for moderating such a thoughtful and engaging discussion. Please join me in giving them all a huge round of applause.